Hello and welcome back to my channel. If you don't know me, my name is Sosa, and in today's video I'm going to be talking about some of the numbers that you should know before you buy a house. So if you're interested in finding out more, please stick around because I got a lot to share with you. So the first number that most people know about is your credit score. So what's a credit score? So a credit score is basically a number from 300 to 800 that represents the credit worthiness of an individual. So the lower the score, the more risk that an institution like a bank or whoever is trying to give you money, they think that you might be a little bit riskier. A higher score towards the 700s to 800 feel like they can trust that you will end up repaying the amount of money that they're giving you with interest on top, of course. So what does this number say about you when you're going to go buy a house? A bunch of numbers are going to be used to determine how much money you can take out, how much interest that they're going to put on top of what they plan to give you. So if you have a lower score, then your interest rate is going to shoot through the roof, versus if you have a more stable credit score, the 700s, 800s range, then you're going to be able to have a lot more leverage to be able to claim a lower interest rate. So a credit score is one of the most important indicators of your financial status. Okay, so let's work through some numbers. Let's say that you want to buy a $200,000 house. You plan on putting 20% down, which makes your loan amount $160,000. And so if we have a credit score within the 700s to 720s, and with that credit score, we're able to get an interest rate of 3.125%. Over the life of our loan, which is about 30 years, we'll end up paying a little over $86,000 in interest fees. So let's say that our credit score is a little bit lower. Let's say that our credit score is around 600. And instead our interest rate goes up a bit to 3.625%. The 3.625% interest rate on our $160,000 loan means that our interest after 30 years is over $102,000. So just from a difference of 100 points in credit scores, we can save $15,000 or lose $15,000, whichever way you want to look at it. But you can kind of see in that very simple example how a credit score can make an impact when it comes to taking out a loan. So the next number that you want to think about is your debt to income ratio. So what does that mean? A debt to income ratio is a calculation that indicates what amount of your income goes into debt repayment. So this is a really cool calculation to do in order to get a sense of your financial health, and banks will do it as well to decide how much they can give you from looking at how much money you already owe in other debt. To calculate your debt to income ratio, all you have to do is add up all your monthly debts and divide by your gross monthly income, which is how much you make before taxes. So for example, if your rent is $1,500 a month, another $100 a month that goes to your car payment, $400 a month that goes into all other debt payments. So then your total monthly debt are $2,000. And if you have, let's say, $6,000 coming in every month, that puts you at a debt to income ratio of 33%. There have been a number of studies that show that people who have higher debt to income ratios might end up having a harder time paying those debts off. A lot of banks want 43% or lower debt to income ratio in order for you to qualify for a mortgage. There can be exceptions, of course, if your debt to income ratio is higher than 43%. These are numbers that you would have to talk through with your mortgage lender, but it's important to still know this number and to be able to do this calculation on your own so that you're not surprised when it comes down to actually having these conversations with a mortgage lender. Another number that you have to think about, and you probably already know this one, down payments. When people think about buying houses, this is usually the first thing that they think about. How much am I going to put down on the house itself? A lot of people will pay from 10 to 20%. You could even go lower than that. There are loans where you only have to put down 3.5%. Or if you're an investor in buying rental property like I did, you might be asked to put down even more. So usually 25% down. So if the home is $100,000 and you're asked to put 20% down, you should be able to come to the table on closing day with $20,000 $100,000. The greater your down payment, the lower your monthly mortgage payment will be. However, if you don't have a big enough down payment, mortgage lenders might offer you a PMI, which is a private mortgage insurance, in which they will tack on an extra amount of money each month to cover them in case you're not able to pay your mortgage on time. So this has the benefit of allowing you to put less money down, but you also then have to factor in the fact that now you're paying a little bit extra every month, which obviously then adds to your monthly mortgage payment. Depending on the price of your home, it could become a significant portion of your mortgage payment. So a lot of times people will say to try to put down at least 20% if you can, so that you don't end up with a PMI. But if you really want the home, and if you can make do with a PMI every month and it's not something that's going to be a hardship for you, then yeah, it allows you to be able to get the home without having to clear out your savings and all your emergency funds and things like that. In relation to our down payment, there's also closing costs. So closing costs are some of the additional fees that come with buying a home. So besides the down payment, you also have to be able to budget for closing costs as well. And closing costs can range from 2 to 5% of the purchase price. So on a home that is $100,000, that 2%, an extra $2,000 that you then have to be able to budget on top of the down payment. In special cases, you might even be able to get the seller to pay for these closing costs. But if you're in a very hot market, like most real estate markets are right now, then that probably won't be an option for you. Remember, not only do you have your down payment, but you also have closing costs that you have to think about as well. So another number to think about is how much you have in assets and savings. Mortgage lenders want to take a look at how much you have to be able to cover the down payment and closing costs, but that you can also have enough money after the fact to account for taxes, principal of the mortgage for like 6 months, let's say, as well as any insurance payments that you have to pay for the next 3 to 6 months. They want to see that you have enough of a buffer in case anything were to go wrong, or just to see that you can actually afford the house that they plan on giving you money for. On top of closing costs and the down payment, you also have to have a little bit of a buffer so that banks are seeing that you're not completely wiping yourself out once you buy this home. There's a lot of things that can be qualified as an asset. Usually we'll take investment counts into consideration. They'll also take like 401ks into consideration. Again, conversations that you should have with your mortgage lender, but just know that this is something that they will also be looking for, and it's a number that you should probably also start thinking about. So those are some of the numbers off the top of my head that I think are super important. I hope this video was helpful for you. Please make sure to do more research on your end. This video is just to scratch the surface and just introduce you to some of these terms and numbers that you should, start getting to know. So yeah, hope this video was helpful, and I'll talk to you later.